Now, when we talk of rational investors, they will always try their best to earn higher interest rate, isn't it? Now, any sensible and a rational investor would like to earn a higher return on their investment or return on the funds which they invest in. Now, assume a certain currency pair. We'll take example of pounds and US dollars. Now, let's say the UK interest rates are high as compared to the US. Now, naturally, from any rational investor's perspective, they would start pursuing assets which are in the UK, isn't it? Because they are yielding a higher interest rate. So, because of this, the investors in the United States will start investing in UK assets to earn a higher rate. That's just a natural response. Now, along with this, there are other global investors who will be tracking the things which are happening in the UK market as well. So they may also want to borrow cheaply in US dollars, and they may want to invest the proceeds in UK or invest the proceeds in British pounds in order to make a profit from that interest rate differential. Now, this can result in temporary inefficiencies. Yes, so there will definitely be a temporary price inefficiency which can give rise to certain arbitrage opportunities. However, the thing with arbitrage is when more and more people start capitalizing or transacting on that arbitrage opportunity, that opportunity is going to vanish. And when you say the arbitrage opportunity vanishes, that means in the medium to long term, equilibrium price levels are going to prevail. So, so this is what you generally observe. Now, if we continue with the same example, now as more and more people are borrowing US dollars in order to purchase pounds because everyone wants to earn that higher interest rate which is being offered in the UK, we'll observe that the demand for British pounds is going to rise naturally, isn't it? Because if more and more people want to invest in British pounds, then they'll have to purchase British pounds in order to invest in the asset which is denominated in GBP. So that's why the spot GBP USD rate is naturally going to increase because the demand is rising. Simultaneously, we'll observe that the forward GBP to USD rate is going to drop. Now, this will happen because the interest rates in British pounds are very, very high. So that way, if you think from an interest rate parity equation perspective, we are dividing by a larger quantum. So that way, this is going to have an impact on the forward rate. So forward rates are going to drop. And it is because of this phenomena that investors won't be able to make an arbitrage profit because market forces are going to ensure that the covered interest rate parity holds. Now, what is covered interest rate parity? We are going to discuss through a simple example in the next slide. But this is an important idea because this section here will help us see the interplay between the way in which spot rates and the forward rates interact. And this helps us further get clarity on the way in which the IRP equation functions, or more precisely, covered interest rate parity functions. There is something which we call as an uncovered interest rate parity as well, something which we'll be discussing towards the end of this video. But next, we are going to further try and dig deeper into the covered interest rate parity thing because if you see this previous sentence, this is something which we want to justify. That is, investors not being able to make an arbitrage profit because of market forces. So, to justify this sentence, which I have highlighted in a star, we are going to use the idea of this covered interest rate parity. So, let's look at that through a simple example. Now, let's try to understand how exactly the forward rate, which is calculated as per the IRP equation, is something which we call as a no arbitrage rate, something which we'll study under this covered interest rate parity idea. Now we have the formula for IRP, which we had written earlier. We are going to take the same GBP and USD pair. So for GBP USD, if we assume the indirect quotation, and we have GBP as the foreign currency and USD as the domestic currency. So we had, if you recollect, 1 plus RDC upon 1 plus RFC. So the domestic currency is US dollars and the foreign currency is British pounds. Now let's put numbers to this and understand. Now assume that there is a certain dealer that has 100 pounds and they want to end up in US dollars in certain time T years. Now there are two ways in which they can do it. So approach one, the dealer invests the British pounds, which are 100 GBP at the going British interest rate, which we call as RGBP. And this investment will grow to 100 into 1 plus RGBP raised to T, simple time value of money calculation. And at the same time, the dealer can enter into a forward exchange rate contract to exchange this quantum 100 into 1 plus GBP, 1 plus R GBP raised to T into US dollars at time T. So this can be approach one. Next, you have a second approach whereby the dealer will exchange pounds for US dollars right now. That is 100 GBP will be worth 100 S US dollars, and these will be invested in the American exchange rate of RUSD, and this will grow as 100 S into 1 plus RUSD raised to T by time T. So these are two approaches which a dealer might want to take in case they want to end up in US dollars. Now, which approach the dealer might want to use would depend on this equation, which we will further slice and dice and see. Now, here we have taken equality. Now, let's understand that from an inequality perspective as well, which will help us review two more scenarios for clarity. Now, let's take scenario one, whereby the forward rate at time t is less than the terms on the right-hand side. So we can think of this as it is cheaper to borrow in British pounds or GBP. Now, if it is cheaper to borrow in GBP, it's always good to do that. Right? Now, any place whereby you can get cheaper funds, you should. It's always profitable from your trade perspective. So, since it is cheaper to borrow in pounds, we do the same. So we borrow 100 GBP for a T years time. We will convert this 100 GBP into US dollars right now, and we will convert this at the going spot rate of S. We will invest this money in the US market so that we earn the US rate of interest, and it will be 100 S into 1 plus R USD raised to T. Now, at the same time, we also enter into a forward contract, which will allow us to convert back into pounds so that we have 100 S into this 1 plus R USD thing divided by F. Now, F is our forward rate. So at time T, we are going to convert this quantum in US dollars right here into British pounds using the forward rate. And through this, a trader will be able to earn more GBP than it is required to repay the borrowing which it had done in British pounds. So that way they are able to capture that profit. Now let's take a scenario two, whereby the forward rate is greater than the terms on the right hand side. So you can imagine that it is cheaper to borrow in US dollars. Now, if it is cheaper, we borrow 100 S US dollars and we do it for T years. Of course, the rate at which we are borrowing is RUSD. So our borrowing is going to be calculated on this rate. Now, this is converted to GBP 100 and we invest it for T years. We also enter into a forward contract to convert this USD 100 and this quantum, which is in US dollars, at time T. So basically, since we have done the borrowing in US dollars, we are trying to reconvert back into USD. And that quantum will be higher than the rate at which we had borrowed earlier. So that way the trader can earn more USD than it is required to repay the borrowed funds in US dollars. So that way, this helps us further understand the nitty-gritties of the formula which is there in this covered interest rate parity. So this further demonstrates the point that the forward rate which is calculated by the IRP is a no arbitrage rate. And whenever there's any kind of imbalance in this equation, there is a potential for us to earn a certain return or a certain profit, which we understand through scenarios one and scenarios two.